silver ripped to roughly $117, slammed $14 an hours, then snapped back toward 109 before most people finished their morning coffee. That is not drift. That is a liquidity event happening right now. And if you saw that move and thought you missed it, you are actually early. Because what just happened was not about the headline number. It was about who got forced out and who quietly stepped in while the candles were still smoking. If you are holding silver, watching it, stacking it, or even ignoring it in your portfolio, this move affects your purchasing power whether you acted or not. Here is what almost nobody is talking about. While price was getting slammed, premiums at dealers barely moved. Delivery delays stayed firm. Open interest dropped faster than price. That is not distribution. That is a flush. And if you are watching this video right now, you are ahead of the people who will read about this pattern in a headline 3 weeks from now, after it already repeated. Quick ask. Subscribe if you want to stay in the group that watches signals before the news cycle catches up. We are building a community that tracks structure, not hype. One thing I need from you today. Comment below with what premiums look like at your local dealer or online right now. Did they drop during the dip? Are delivery times shorter or still delayed? That data matters more than any chart, and we will use it together as a real-time signal board. Let us get into this. Here is what happened at the surface level. Silver had been grinding higher for weeks. Stops stacked up above recent highs. Liquidity thinned as the move extended. Then large sell orders hit the order book hard. Price gapped down. Leveraged longs got liquidated. Panic spread. The move looked like a breakdown. But here's the hidden layer most people will miss. While price was falling, the physical market did not behave like a bearish market. Premiums stayed sticky. Some mints still showed delays. ETF outflows were smaller than the futures liquidation would suggest. Warehouse inventories kept drawing. Open interest collapsed faster than it should have if this were real distribution. Think about that. If this were genuine weakness, premiums would have dropped hard. Dealers would be desperate to move inventory. Delivery times would shrink. None of that happened. So here is the question you need to sit with. If the paper market says sell and the physical market says hold, which one is lying? Circle that. Because understanding that gap is how you avoid getting shaken out at exactly the wrong time. Let me name the first pattern simply. The liquidity flush. This is when price gets slammed through crowded levels to force liquidations, then rebounds when the pressure stops and real buyers step in. Not a conspiracy, just mechanics. Think of it like firefighters using a hose to clear a hallway so they can move through it. The water is not the enemy. It is the tool to create space. In markets, big players push price through zones where stops are stacked. Leveraged traders get hit. Forced selling cascades. Liquidity drains. Then the same players who pushed it down start buying into the vacuum at better prices. You see this in metals. You see it in commodities. You see it in crypto. Anywhere leverage exists and stops cluster, this pattern repeats. Why does it repeat? Because human behavior is predictable. Retail stacks stops at obvious levels. Breakout traders pile in late. Leverage amplifies emotion. And every time, the same flush happens. Not telling you this is manipulation, showing you this is structure. Your job is not to predict when it happens. Your job is to recognize it while it is happening, so you do not panic sell into the exact bottom of the move. Here is the kicker. The next flush usually comes right when everyone feels safe again, when volatility drops, when the crowd stops watching. That is when the setup rebuilds. Now let me show you the second mechanism that confirms the flush. Premium price divergence. Paper markets can print any number they want. Futures can gap. ETFs can show outflows. But physical markets have constraints. Mints have capacity limits. Dealers hold inventory. Shipping takes time. Fabrication has lead times. When paper price falls but physical premiums refuse to follow, that is a signal. It tells you the real-world market is not agreeing with the paper move. Imagine you are a dealer. Price just dropped 10%. If demand were truly weak, you would slash premiums to move inventory. You would offer faster delivery. You would compete for buyers. But if demand is still firm, you hold your premium. You keep your delivery window. You wait. That is exactly what we are seeing right now. Retail premiums barely budged. Delays stayed in place. Some products are still backordered. That divergence matters because it signals underlying scarcity even while price is falling. Not predicting where price goes next, showing you what the behavior is telling us about supply and demand reality versus paper perception. When divergence widens, it can precede sharp upside repricing as the paper market eventually snaps back to physical reality. When divergence collapses and premiums fall with price, that warns you demand is actually cooling and the move might have more room to run lower. Right now, we are in the first scenario. Here is what you need to understand. The chart you are watching is only half the market. The other half does not show up on your screen. It shows up as premiums, delivery delays, and allocation limits. And right now, those two halves are telling different stories. Let me connect these two patterns. The flush creates the divergence. When leveraged paper hands get forced out, physical buyers step in because they are not playing the same game. Paper traders are watching 15-minute candles and managing margin. Physical buyers are watching geopolitical risk, currency debasement, and supply tightness over quarters and years. So when price drops, one group panics and the other group sees a discount. The flush drains the leveraged. The divergence shows who is accumulating. Look at the open interest data. It dropped faster than price, which means contracts were being closed, not rolled. That is weak hands leaving. Look at the commercial positioning. Shorts reduced into the drop. That means the players who typically sell rallies were actually covering, not adding. That is the opposite of what you would see in a sustained breakdown. Now imagine you are holding physical silver. You see price drop $14 an hour. Do you panic? Or do you check your dealer and see premiums still firm, delivery still delayed, and realize the paper market just got flushed while the physical market stayed tight? If you understand the pattern, you stay calm. If you do not, you sell into the bottom and get shaken out right before the snapback. Can it reverse and go lower? Absolutely. Could the divergence collapse tomorrow? Yes, but right now the behavior is not matching the price action, and that mismatch is information. Here is what you need to sit with. The question is not, will silver go up or will it go down? That is noise. The real question is, who is being forced out right now, and who is quietly accumulating while everyone else is watching the candles? Because those two groups do not trade the same way, they do not think the same way, and they do not end up in the same place 6 months from now. If you misread a flush, you sell the bottom. If you recognize it, you either hold through it or you use it. The stakes are not just missing a move. The stakes are getting shaken out of a position you spent months building because you could not tell the difference between a breakdown and a liquidation event. So let me give you the exact signals to watch this week. First, scenarios, not predictions, paths. Scenario 1, continuation flush. Volatility stays high. We see another leg down as remaining leveraged positions get squeezed. Dollar strengthens temporarily. Headlines get more bearish. But premiums stay firm, and physical buyers keep absorbing supply. In this path, weak hands keep getting flushed, while strong hands accumulate at better prices. If you are a trader, you respect the volatility and manage risk tight. If you are a holder, you accept that price might shake lower before it stabilizes. Scenario 2, base building. Price chops in a range between roughly 103 and 112. Volatility compresses. Open interest stabilizes. Premiums hold or tick slightly lower but do not collapse. This path means the flush worked, weak hands are gone, and the market is resetting before the next directional move. If you are waiting to add, this range gives you time. If you are holding, this is where patience pays. Scenario 3, surprise breakout. Dollar breaks support. Geopolitical headline accelerates safe haven bid. Short covering intensifies. Premium divergence widens further as physical demand spikes. Price rips back through 117 and does not look back. In this path, the flush becomes the launchpad, because all the weak hands are already gone, and the only thing left is momentum and scrambling shorts. If you are positioned, you benefit. If you are waiting for confirmation, you chase. Could not tell you which path we are on. Can tell you what signals will show us which one is unfolding. Here is what I am tracking this week. Not advice, pattern recognition. Signal 1. COMEX silver open interest versus price. Normal behavior is open interest rises with price and falls with price. Stress behavior is open interest falls faster than price on dips. That tells you leveraged longs are being flushed, not that new sellers are piling in. Right now, we saw stress behavior. If open interest keeps dropping while price stabilizes or bounces, that confirms weak hands are gone. If open interest rises on the next dip, that warns fresh shorts are entering, and the move might have more room down. Signal 2. Retail dealer premiums and delivery delays. Normal behavior is premiums compress when price falls, because dealers want to move inventory. Stress behavior is premiums stay firm or even rise, because underlying demand is absorbing supply faster than price suggests. Check 2 or 3 major online dealers daily. Watch premium changes on common products like Eagles or Maples. Ask about delivery windows. If premiums drop below $2 over spot and delivery shrinks to same week, that warns demand is cooling. If premiums hold above $3.50 and delivery stays multiple weeks, that confirms physical tightness regardless of paper price. Right now, premiums are holding firm. Signal 3. Dollar index near-term trend. Normal behavior is silver and the dollar move inversely. Stress behavior is dollar breaks key support and commodities accelerate. Watch DXY around the 103 to 104 zone. If it breaks and holds below, that adds fuel to metals. If it bounces hard, that pressures silver short-term. Not a standalone signal. Confirmation signal. Signal 4. SLV ETF daily creations and redemptions. Normal behavior is small daily fluctuations. Stress behavior is large redemptions that do not match the future's liquidation size. If we see massive SLV outflows while futures open interest drops even harder, that tells you the ETF selling is not the full story. Somebody else is buying physical while ETF holders are selling paper. Right now, ETF outflows were smaller than expected given the price move. That is interesting. Signal 5. Gold-silver ratio compression. Normal behavior is the ratio drifts. Stress behavior is silver outperforms on up days and underperforms less on down days. If the ratio compresses below 75, that signals silver is gaining relative strength. If it spikes back above 80, that warns silver is lagging and momentum is weak. Right now, we are hovering mid-70s. Watch the next bounce. Does silver rip harder than gold? That confirms relative strength. Here is how I am watching this. Not telling you what to do, showing you my framework. If you are a trader, respect this volatility. Do not size up into chop. Wait for structure to clarify. Use smaller position sizes and wider stops or none at all until a clear trend reestablishes. If you are a long-term holder, accept that pullbacks are part of the process. Your job is not to trade every wiggle. Your job is to hold through noise and add on flushes if your thesis has not changed. Know what you own and why you own it. If you are new and trying to learn, this is not the week to chase. This is the week to watch and take notes. See how the signals play out. Compare what price does versus what premiums do. Build pattern recognition without risking capital. Can this all reverse tomorrow? Yes. Could premiums collapse and prove the divergence was temporary? Absolutely. Could dollar strength crush metals for weeks? It has happened before. No guarantees, no certainty, only frameworks to interpret what is happening in real time, so you can make informed decisions instead of emotional ones. Your edge is not predicting. Your edge is interpreting behavior while everyone else is reacting to price. Quick hedges. Volatility can spike further before it settles. Geopolitical headlines can shift overnight. Dollar could bounce hard if risk-off accelerates in equities. Central bank policy shifts could change the macro backdrop fast. Liquidity can dry up during sharp moves, making exits harder than entries. Physical premiums can collapse if a recession genuinely hits and demand craters. Not fear-mongering, risk awareness. If you are positioned, know your exits. If you are watching, do not assume the move is over just because it paused. Here is what I want you to take from this. If you stay disciplined and watch the signals instead of reacting to the candles, you put yourself in the group that does not get shaken out at the worst possible time. You become harder to fool. You stop selling bottoms and chasing tops. You start recognizing patterns that repeat across markets and time frames. That is the goal. Not to call the exact top or bottom, to understand what is happening beneath the surface so you can position intelligently instead of emotionally. Quick engagement ask. Comment below and tell me what premiums look like where you are. Did they drop with price or stay firm? Are you seeing delivery delays or instant availability? That data helps all of us build a real-time picture of what the physical market is actually doing. And if you have ever spotted a pattern like this before it played out and it kept you from making a bad decision, share that story. Community learns faster when we share what works. Subscribe if you want to keep tracking these signals with us. We are not here to hype. We are here to watch, interpret, and stay ahead of the noise. Let me leave you with this. Price is noise. Behavior is truth. The chart shows you what happened. The premiums, the delays, the open interest, the positioning data. That shows you why it happened and who is moving. If you are watching those signals, you are already in the group that sees structure before headlines catch up. Stay sharp. Links below. I will see you in the next one.